One of the debates or conversations that we always have when it comes to allocating to international equities, we all know the research on passives versus active, and certainly case could be made that for some part of your portfolio you want to have more passive strategies. But then the real question is, for international markets, which aggregate so many countries and geographies and currencies, can you afford to be straight passive when it comes to international investment, or do you really need the active benefit of being able to overweight and underweight certain geographies depending on geopolitical landscapes?
Right. Yeah. And, this is obviously, I won't say an existential question, but a big question that goes on in many investors' minds and in many advisors' minds as well: where to allocate to active strategies and when to do so. I think a good rule of thumb is the more efficient a market is, the harder it is for active managers to outperform. So when you look at US large cap, for example, huge amount of analysts cover each of those companies, huge amount of information out there. So very hard to get an edge as an active manager. Largely, we see the same with developed markets internationally. And so I'm thinking about that MSCI EFI type exposure with developed countries as part of that, typically are very widely followed and very well known as well. When we get into the emerging markets, that could be a space where, an investor, there's a little bit less efficiency in those markets, and an active investor or advisor can potentially outperform that index. Now, I would also say, both of these indices cover a wide variety of countries, as you mentioned, and we do see active managers tend to be, in the EM space anyway, a bit more country specific. So, for example, a China manager or Indian focused, for example. So if you can cobble together a couple of those active managers in those countries, you can get a broader based exposure.